Hi, it's Professor Mike, and we're going to be talking about completing the test in the acquisition and payment cycle. So, some other accounts besides accounts payable in the acquisition and payment cycle. So, there's many items which you purchase: property and equipment, prepaid expenses. You do have other liabilities, and you have income and expense accounts. All of these get impacted by the acquisition and payment cycle. So, if you think about, assets. You're going to have inventory, you're going to have supplies, property and equipment, patents, trademarks, and a bunch of prepaid items. On the expense side, everything goes through the acquisition cycle, and then obviously liabilities. I don't know what the hell rent payable is, honestly. I've never been able to pay rent in arrears, but we'll go with it. You do pay like operating expenses and stuff that you get an invoice for, but I've never seen rent be accrued. So, um, professional fees, property taxes, again, can be paid at different times. So I find this next chart to be very relevant and important for you if you get my drift. So there's a difference in approach in how we do auditing for different accounts. The stuff that turns over on the asset side, cash and equivalents, accounts receivable, inventory, prepaids, all those things we should audit the financial statement balance of, right, as of year end. Same goes for accounts payable, accrued liabilities, and short term debt, because all those things should turn over multiple times within a year. The things that don't turn over, like fixed assets, goodwill, intangible assets, other long term assets, and then long term liabilities and equity, we audit the transactions because those balances should build up over time. So let's take fixed assets, for example. You already audited, or your firm audited, fixed assets in a prior audit. So why would you go back and re-audit an acquisition of an item from 2 years ago? You wouldn't, and it doesn't make sense, and nor should the client pay for it, right? So you're relying on the beginning balance that was already previously audited, and then the additions to fixed assets you will audit. So you're auditing a transaction. Whereas when you go and look at accounts receivable, you get the ledger as of December 31st on a 12/31 year end. And those accounts receivable should not be from the prior year. So those accounts receivable for those invoices, those transactions, even though the customers may be the same, the individual items will not be the same. And so you re-audit those, okay? Or you don't re-audit them, you completely audit them because they haven't been audited before. So understand that distinction. So if you think about it, like for equipment, the beginning balance plus acquisitions minus disposals equals your ending balance. And this is how the accounts work together, right? And when you look at the different items, and you probably covered this in intermediate accounting, but a lot of the stuff is you know land improvements, obviously buildings, equipment. Nowadays, like computer equipment, things like that, your laptops are probably not even capitalized, because especially if they're like a Dell, they don't last that long. Um, a 3 year life on a laptop is probably kind of aggressive. And a lot of the laptops that they give to people are, under a few $1,000s. So you set your capitalization policy for, $3,000, and most laptops will not be included in there. Now, auditors will still propose an adjustment that you should probably capitalize those, but that's, to me, that's not very relevant. These things are relatively short-lived nowadays. And especially if you're working with software developers, the economic life of these assets is not that long because just software development chews up a lot of resource. Although nowadays it is getting a lot easier and better. So there's obviously a list of fixed assets, and you basically, if there are a large number of asset acquisitions, then you'll do a sample. Otherwise, you may not run a statistical sample on it. You may look at significant large items and then smaller items. What you're really looking for is, does the asset exist? And so you want to physically observe it if it's a large purchase. And then is it properly accounted for, right? So look at the underlying purchases and look at the asset, look at the invoices, look at the payment, right? Um, so, and then once you've done that, then it's really about, is it categorized correctly so it gets the right depreciation life, right? So the steps, are pretty simple. You do some analytical procedures on, um, especially on depreciation expense, but you can also perform some analytical procedures on acquisitions, and then you'll sample the acquisitions. You'll sample the disposals, and that should roll. Those lists should roll forward into your ending balance. Um, so, um, on the depreciation side, it's really, doing an analytical review. If most of your equipment is a 3-year life, or, equipment or software is 3-year life, then you can basically take the average balance during the year and divide it by 3, and that should be damn close to your depreciation expense. It doesn't need to be any more complex than that, right? So, there's some analytical procedures like, they're outlining the, uh, depreciation expense divided by gross equipment costs. See if that compares to the life, right? So there's very easy analytical procedures you can design for this. Okay, prepaid expenses. Most of the time, prepaid expenses are not material. I had one audit partner who got sued on prepaid expenses one time, and he would audit the heck out of it, even though it was never material, because he'd been scarred, right? So, um, the most of the stuff that you see is going to be like rent. Patents and trademarks and copyrights are not prepaids. Those should be long-term assets. Um, and there's other things like goodwill that should come from acquisitions. So it's really it should be pretty straightforward and subject to analytical procedures. A lot of time, this is a very good account for those samples, those situations that I talked about in the exam where you have inherent risk as low. And you probably don't need to test controls because prepaid expenses are not going to generally be material. And if they are, then you have a higher risk misstatement because you're wondering why is prepaid expenses so high, right? So if you do have controls, if you tested controls over the acquisition cycle, then any detailed test work of prepaids you can reduce. But again, I don't think you're going to be spending a lot of time in prepaids. So insurance, obviously you just, look at the client's computation of the insurance balance based on the premium period, right? And you verify that they have in fact paid the premium. And this is the transactions involving prepaid insurance. When you're looking at accrued liabilities, this is more important and higher risk. A lot of times now in the Valley, you're not going to have accrued payroll. Most of the companies I know pay on 15th and last. So Pure payroll accrual is very limited. If you have some hourly workers, you might be paying them every 2 weeks, so you might have an accrued payroll. If you pay payroll on a 2 week cycle as opposed to 15th and last, then you will likely have a payroll accrual, but it can never be more than 2 weeks worth of pay. So there's all sorts of different things to look at on payroll. It's probably not that big an account. Bonuses and commissions are the places where you're going to spend your time because bonuses are discretionary, and under tax law, they have to be paid within 75 days of year end. And also, this is an area that can be manipulated, right? You can over accrue bonuses in order to help next year, or you could under accrue them. And so you need to look at the bonus schedule, any bonus program that the company has, not just for officers, but for rank and file employees, and look at their judgment accruals that are being done, and then look at subsequent payment of it. So you would go back to last year's bonus accrual and see when that was paid, and verify that it was all paid. Commissions are complex, and again, you want to understand compensation plans because that also affects revenue recognition, but you also want to make sure that appropriate amounts of commissions related to the prior year are in fact accrued. I don't think you're going to see too much in accrued payroll taxes because, quite frankly, unless it's a very big company, if you're using a payroll service, they've already withheld the payroll taxes for both the company and for the employee, and they're responsible for remitting those. Again, accrued rent really doesn't happen, but professional fees like audit fees, lawyer fees, those are things to look at. And then obviously accrued interest on debt. And there can be other accruals. You can have, accrued uninvoiced receipts, things like that. So the understanding accruals and what types of things are happening is really important. Um, you know, Basically, accruals are estimates, and therefore they're higher risk. You can have accrued warranty costs, right? So, when you sell a good or service, you may have a warranty liability for that good or service that you have to satisfy, and you have to make an estimate of future claims against those warranties. Okay. So there are many types of accruals, and so we're not going to go through audit procedures for each of them, but you should be aware of the types of accruals and think about the potential liabilities that the client could have based on their business model, right? Um, so property taxes, you can accrue property taxes, right? Normally if it's a calendar year end in California, you don't need to accrue them because you paid the first half of your property taxes in December already, and so you've got a clean break because that's for the first 6 months of the governmental year, which starts on July 1st. So your property taxes are caught up. If you're non-December 31st year end, like a January 31st, then you will have accrued property taxes. Even though you paid in December, you still owe for the second half of the tax fiscal year, which ends June 30th, and so you'll have 1 month accrual of property taxes. And again, you're looking for consistency as well. So the other side to all this is looking at income and expense accounts. So you want to do strong analytical procedures, including looking at budget to actual, as well as growth, average growth, even month to month or quarter to quarter growth relative to other aspects of the business. So if accrued commissions doesn't grow, or if commission expense doesn't grow when revenue grows, that should be a warning sign, right? If if commissions expense significantly increases when revenue is flat, then that should also be a question, right? Because and that may be completely legitimate. It may be a few employees who are doing all the selling, and therefore they're in bonus territory in terms of their commission, where there's a lot of people not earning any commission. So you could have a ratio that's out of whack, and that would tell the client, hey, we've got to adjust our commission plan because some people are getting it all. Or we've got to look at our sales force and see why some people are effective and others are not, right? Um, most of this is going to be substantive analytical procedures, but you can do test of details and test of controls in some cases, mostly payroll. But in most other and commissions, right? In most other cases, I don't think you'll see, tests of controls, and probably not as much test of transactions. Okay, and here's some analytical procedures that you can go through. A lot of this is pretty self-explanatory, so I won't go through it in detail. You do want to analyze legal expense, and here's why. You want to know what lawyers they are using and for what matters they're using them for, in order to determine who you send legal confirmations to. And one of the audit procedures for making sure that there's no undisclosed litigation is to send letters to attorneys that the company has done business with. They are required under their American Bar Association ethics requirements to respond regarding any cases. They won't necessarily actually give you a conclusion or a probability, but they do. They need to identify cases and claims that are threatened or pending. They will provide that in the description, but they will usually say something like the company has meritorious defenses or something like that. That isn't really that meaningful. So that is chapter 19. On to chapter 20.